Seeds of Wisdom RV and Economics Updates Wednesday afternoon, October 22, 25. Listen to the full version on the official dinarreport.com website and become our supporter on Patreon. Good afternoon. Dinar recaps, Global Reset Watch. Fault lines emerge in banking, currency, and metals markets. Private credit risks, currency interventions, and liquidity strains hint at a slow-motion restructuring of global finance. The warning signs are converging. Today's financial headlines reveal a deeper shift beneath the surface of markets, one that signals not panic, but pre-reset recalibration. Across credit, currency, and commodities, new structural imbalances are aligning to challenge the post-1971 US dollar order. 1. Bank of England flags private credit as systemic risk. Bank of England Governor Andrew Bailey warned that the fast-growing $2.1 trillion private credit market poses echoes of 2008. These private funds lend outside regulated banks, often with high leverage and limited transparency. A cascade of defaults in this sector could force central banks back into emergency interventions, reigniting questions about fiat stability and monetary independence. 2. Washington's currency maneuver in Argentina. Reports indicate the U.S. Treasury purchased Argentine pesos to support Buenos Aires amid crisis talks. The move marks an unusual level of direct foreign exchange intervention by the United States. Using currency policy as a geopolitical instrument risks fragmenting global FX markets and hastening the rise of bilateral or commodity-backed systems, notably within BRICS nations. 3. Metals sell-off signals liquidity stress. Gold and silver fell sharply, down 5 to 9%, despite geopolitical risk. Institutional traders appear to be raising cash or unwinding leverage, a sign of tightening global liquidity. Historically, such safe haven sell-offs precede credit tightening or rate shocks, the early tremors of systemic transition. Why this matters? Each of these developments reflects erosion of confidence in the current financial architecture. Credit fragility, right pointing arrow, unsupervised leverage expansion. Currency interventionism, right pointing arrow, politicized markets. Liquidity compression, right pointing arrow, retreat from real assets. Together, they form a pattern, a slow motion reset of global finance where regional blocs pursue sovereign, commodity-linked frameworks to protect their monetary autonomy. This is not just politics, it's global finance restructuring before our eyes. A system hiding in plain sight. A quiet revolution is underway, not through central banks or parliaments, but through code and corporate balance sheets. The emergence of tokenized US dollars, digital assets like USDT, Tether, USDC, and PayPal USD, is reshaping global finance faster than regulation can respond. Promoted as tools for fast, borderless payments, these tokens are in fact private conduits for dollar demand, each one backed, theoretically, by short-term treasuries and cash reserves. Every transaction, therefore, supports U.S. debt markets, creating a self-reinforcing cycle between digital liquidity and sovereign borrowing. 1. Stablecoins, the invisible bond market. Tether and Circle now collectively hold over $150 billion in U.S. Treasury bills, rivaling the foreign reserves of mid-sized nations. Each new token minted equals a new buyer of American debt, privatized quantitative easing without a central bank vote. For emerging economies, this deepens dependency. The digital dollar becomes both payment rail and debt anchor. 2. Tokenization as control mechanism. Unlike cash, tokenized currencies are programmable, enabling regulators, platforms, or issuers to freeze, track, or even reverse transactions. In a liquidity crisis, such control could instantly bail in users, converting deposits or tokens into sovereign assets. A digital replay of 2013 Cyprus or 1933 gold confiscation. This represents the architecture of a controlled financial reset. Convert global liquidity into tokenized, digital treasuries. Centralize control under payment networks and regulated issuers. Gradually phase out traditional fiat and foreign reserves. 3. The gold hedge paradox. Ironically, while these issuers expand their treasury holdings, their parent firms and executives are buying gold, quietly hedging against the very system they're constructing. This duality, digital dollars for the public, hard assets for the insiders, mirrors late-stage fiat cycles before revaluation events. Why this matters? A global financial reset doesn't require a crash, only a change in the unit of trust. When physical dollars vanish and only tokenized ones remain, monetary sovereignty shifts to those who control the ledgers. This could pave the way for a new hybrid monetary regime, part digital, part commodity-backed, and ultimately transnationally governed. The scaffolding for this system isn't theoretical, it's operational. The only question is whether it evolves into a decentralized upgrade or a digital enclosure. Private stablecoins, public power. Who controls the future of money? Ripple, RLUSD, and the quiet redesign of global finance. The rapid rise of private stablecoins like Ripple's RLUSD marks a profound shift in how money may soon function. Unlike traditional currencies issued by central banks, stablecoins are digitally backed tokens, often pegged to the US dollar, issued by private corporations rather than governments. The decentralization illusion. While stablecoins appear to promise decentralization, most are actually highly centralized within corporate ecosystems. Ripple, Tether, and Circle, issuer of USDC, each maintain custodial reserves, often parked in short-term US treasuries. This means that rather than escaping the current system, stablecoins extended, just through different hands. If Ripple succeeds in becoming a federally chartered bank, it would merge crypto finance and traditional banking, creating a hybrid model where digital currencies circulate globally while remaining tied to US debt markets. Seedling. In essence, the new dollar could be private, programmable, and global, but still fundamentally a US-backed instrument. If governments lose monetary control, if stablecoins or tokenized currencies became the primary medium of exchange, fiscal policy power, like money creation, interest control, could shift from central banks to corporate issuers. Regulation and taxation would become harder to enforce unless governments integrate themselves into the new system. A global ledger run by a few major fintechs could replace national money systems, a true financial reset. This wouldn't be decentralized finance, DeFi, in the original sense. It would be corporate-controlled digital finance, a privatized version of monetary governance. The path toward a reset. Ripple's banking ambitions and tokenization projects by JP Morgan, BIS, and the IMF all signal a new global architecture where real-world assets, treasuries, and currencies exist on interoperable ledgers. Once major economies adopt tokenized fiat, they can reprice, or reset, global value without a crash, simply through revaluation of digital instruments. The reset would be a software upgrade, not a collapse. Why this matters? The future may not be decentralized, in the libertarian sense, but digitally centralized under private-public partnerships. The reset is already under construction, not by central banks alone, but by those who build the rails that money runs on. This is not just politics, it's global finance restructuring before our eyes. Listen to the full version on the official dinarreport.com website and become our supporter on Patreon. Source: dinarrecaps.com